Welcome to Cultivated Live on this, I guess it's St. Patrick's Day. Today's the 17th. Happy St.
It
Patrick's
is.
Day, everybody. I forgot about that until this very second. I guess we'll be going out tonight for some drinks. I am Jay Rosenthal. Over there is Jeremy Birkin. In the middle is Aaron Miles from Verano. Aaron, thanks for being here.
Great. Thanks for having me again.
We're going to try to do this on a regular cadence. It seems like we already are. Give us an update. I think you had your earnings call and a big announcement about some financing. Give us the top line, and then we'll dive into some details.
Yeah. So overall, top line in the year was 822 million, 28% adjusted EBITDA margins. For the quarter, we were at 207 million and 27%, which was in line with what we had guided to for the quarter, 27 to 30%. The nice thing that we experienced in the fourth quarter is that we were up 4 million sequentially. I think we're seeing a lot of pressure quarter to quarter, and we were up sequentially on the top line and up sequentially on the margin line. But the bigger news really coming out of the quarter was the debt refi. Obviously I know that was a massive overhang on our stock, but to announce 195 million, get a regional bank like Needham in, and we printed SOFR plus 5.5% with a 4% floor of SOFR. I mean, that's 9.5% in a rate, in a current environment like we're in right now. And so we're really happy with the way that we're managing the balance sheet. And what we were to be able to build into that debt facility was a lot of flexibility. So the prepayment, penalties in years 1 and 2 are about 1.5%. Years 3, there's none. So when you think about potential moves, federal level, does banking come in? What we really wanted to do was make sure that we were building in that type of flexibility. But overall, really happy. I mean, we're number 3 in all the product categories from a market share perspective, and every category that we compete in. We just regained number 1 market share in New Jersey. We gained 4% market share in Florida, which really shows a lot of the efforts that we put into revamping our CPG facilities are taking root. So, I like where we're at. I mean, we're in that moment where it's like there's a lot of uncertainty around, moves at the federal level, but we're taking care of what we can take care of. And we touched on this last time, like, we redomesticated from Nevada and from Canada into Nevada. We're on a senior exchange, in the CIO. It's not, a big name exchange, but what it does is it aligns us with the listing standards and the bylaws of the NYSE and the NASDAQ. And so you start to think about moves that we can make, from a capital markets perspective. We're positioning ourselves well. And, let's call it the obvious here. Spanberger, won the election in Virginia. We bought that asset from the cannabis last year. That's set to turn on Jan 1. Obviously fingers crossed, but as they're dotting their I's and crossing their T's, but that's a massive market. We're in the Virginia Beach area, 14 million tourists every year. So that's a big state for us. And, the last thing I'll say here is we won one of the 9 coveted Texas licenses. And so you think about, that potentially being another Florida type-esque market. And then our kind of MO of really being able to build a strong footprint in those types of states. I like where we're at. I really do. And again, we don't take any day for granted. And obviously we have a lot of work to do. And, I'm not naive to where our stock's trading at, but, listen, we keep our head down and we worry about what we worry about. And hopefully bigger moves are coming.
Yeah. Aaron, can you talk a little bit about the debt refinancing? 9.5% is a pretty good rate for the cannabis industry right now. Is this a sign that lenders are starting to get a little bit more excited about the space? I mean, both Verano and many of your competitors have debt coming due, so we're probably going to see a lot of these deals. So, what's your take on the overall lending environment right now?
I mean, we had some really interesting conversations during the debt refi, and I think we didn't feel the pressure to get something done 6 months ago. I mean, obviously, I had to answer those questions every day, but the closer we get to Schedule 3, the more banks are starting to pay attention to this space. And, I won't name names, but there are big banks that are paying attention. And again, that's, part of why we really wanted to build flexibility into this facility is, in case, things start to move rapidly and we start to become real companies, and start to get, a real facility at just kind of market rates. But I would say, there's two components to this, Jeremy. Yes, banks are paying more attention, to get a bank like Needham. I mean, they were an amazing partner. We've known them for years now, and for them to actually really start to back a company like ours, like we were absolutely ecstatic about that. But it's also not an apples to apples comparison of our company versus others. Like we don't have any sale leasebacks, which is really an outlier in this space. So to be able to leverage our real estate was part of why we were able to really secure such a great rate. And you just look at the performance of the business, right? We're cash flow positive. I mean, the margins that we print are strong. I mean, they've been higher in the past, and we know what we're capable of doing. But I just think in the combination of movement towards Schedule 3, we are having some very productive conversations, and then the kind of company that we built is very attractive for a bank like Needham to lend to.
You touched on Virginia, Florida, and Texas. Florida, there was news over the past, 10 days that their measure likely won't go forward for 2026. Like, what is the thesis that the medical market will just continue to grow, easier access over time? Like, is that sort of what you're planning for? And how important would sort of another ballot measure be given the right circumstances? I don't know, an even number year or an odd number year?
Yeah, I mean, medical or rec, Florida is such a significant state for us. And, we talked about $30 to $50 million of CapEx in the year, 5 to 10 dispensaries opening. And probably the bulk majority of those 5 to 10 are going to be in Florida. So even in a medical market, we see the ability to expand our footprint, right? And we have the ability to ramp up our CPG and put supply into those stores. It's heartbreaking that, first of all, I mean, it's become a political game for DeSantis. And shame on him, a guy who, apparently backs, veterans and, access to, different types of medicines, that they're limiting the ability for a market to actually gain access to a medicine that can be tremendously helpful to people. And, it shows you that politics sometimes mean more than the people that actually put the votes behind these people. And so I would say we're still very positive on Florida. I would say it's probably not a near term, flip to adult use. I hope I'm wrong, but does it happen legislatively? Does it happen through a ballot initiative? I mean, we're already looking at who could potentially come in as the incumbent for the next governor, and you start to work with those types of people and get their ideas and what their views on cannabis are. But it's heartbreaking to have a game politically being played that there's people who are dying every day who don't have access to this medicine. And so but Florida is going to be a big market for us. We're going to continue to look to expand in Florida. And as I said, from November to December, we gained 4% market share. And that wasn't by accident, that was by design. And I do, want to highlight as well, when you actually look at our footprint, with Texas, Florida, Virginia, and Pennsylvania, we're the only company that has that in the cannabis space. And so when we think about, future growth catalysts, we really like where we're at.
Yeah. Aaron, can you talk a little bit about the revenue trend? I mean, it's sort of down sequentially a little bit for Verano. How do you view this as a broader sign in the MSO space more generally, right? Because Virginia is coming online, while Florida may not shift to recreational, like there are these catalysts coming, that may change. Like, are we in, to ask this question, like, are we in a bottom environment? Are things changing? How do you see that playing out over the next couple quarters and next year?
So year over year, I mean, there's so many factors that play into, revenue declines in the space. And, one of them is, think about like when New Jersey turned on, right? There was 13 stores that were open. We had 2 of the 13 that were open for adult use. Think about the amount of revenue that you run through those types of stores. And then you start to think of what those year over year comps look like as the market normalizes and more dispensaries start to come on. So you have normalization of markets. I mean, you have difficult comps just based off of adult use transitions and those markets normalizing. Price compression, right? I mean, you have oversupply in these markets, and it's had a real impact on this industry. But for us, we were down year over year, but sequentially in the fourth quarter we showed growth, and we were really happy to produce a top line of 4 million above what Q3 was. But I mean, the pressure is still there, and we have everybody's feeling the pressure, and it's like we're feeling the pressure from a pricing compression perspective. And you can imagine the people that we're selling into. I know we touched on this last time from an accounts receivable perspective. Like, if you're not getting paid, you're not getting product. And if we're not getting paid, we can't recognize that revenue. And that was a real impact. And so, on our call, we highlighted that we turned down about 60% of the accounts that we had shut off. But keep in mind, we don't do that at 100%. So it's almost like that, toe dip in the water. Are you going to pay your bills? And then you start to ramp up those relationships. So it's a plethora of things, right? It's pricing compression. It's tough comps as markets start to normalize after going into adult use. And then it's also people, obviously struggling just as much as some other companies are and not paying their bills. So I would say what we're looking at is to really enhance the footprint that we have. We've talked about scrubbing down our CPG facilities, making sure that the product that we're putting into market is top quality. We're changing the customer experience. We launched bodega style dispensary in Arizona, and those dispensaries are actually outperforming the market decline. So it's we're taking care of what we can take care of, and so again, it's starting to show up back in the numbers, right? Market share gains in Florida. We're number one in New Jersey, and going again, being the top 3 player in all the product categories that we compete in is showing up from the efforts that we're putting into the business. So we're trying to stabilize as much as we can, but it's hard to say if this is the bottom. It kind of feels like it, but again, this is cannabis, so tomorrow could look a lot different than today, and we don't take anything for granted. Which again, look at our debt facility. I've gotten questions, why didn't you take more, and why didn't you do listen, we took what we needed, and again, we see what bigger states turning on are going to look like. Virginia is going to be a massive turn on for us, once that happens, and once we get DeSantis out of office and get Florida rocking. I mean, we quantified that at 300 to 450 million of additional revenue on the top line, and so you start to think about what these catalysts look like and get Texas up and running, and we really like where we're at, and but we have to be very conservative because there's no guarantees tomorrow, and that's the way we run our business.
Everything you just described obviously affects you in those markets, like leaning into New Jersey, right? The market has changed dramatically year over year since it launched, both in competition, price compression. Other markets surrounding have opened up or become closer, like in New York. Talk a bit about sort of a strategy you're thinking about or would think about in terms of acquisitions or mergers and acquisitions either in those markets, because as you're sort of dealing with those blows of price compression and other competition, so are mom and pops who are having, or small retailers who are having a tougher time in the market. Like, is that part of the plan? And is it market specific? And sort of what would the factors be to make it attractive?
Sure. We've always looked at M&A. I mean, we've been in a very aggressive, acquirer. I mean, when we went public in that first year, we had 69, closed acquisitions, and
happy lawyers.
Yeah, happy lawyers. Yeah. And I will tell you, we've definitely beefed up our internal capacity because paying billable hours is a lot when you're doing that many. But we have the best legal team in the space. But I will say this, we're constantly having conversations, and you look at what we did in Virginia and Arizona with the cannabis. Like, we were able to develop a really strong relationship with the cannabis, and when they had a need to dispose of some assets, we were kind of first in line to have those conversations. And so, we're always looking to go deeper in the appropriate states. Obviously there's caps in certain states that we can't go deeper in. But states like Arizona, Nevada, we've mentioned on calls. Florida will probably do more from an organic perspective, but I would say we're always looking at M&A, but we're also hyper patient. You look at what we paid for Virginia and Arizona. At the time, it was about 90 million, and then we retired a seller's note that we sent to them, and saved about 5 million. And you look at where our stock's trading, and then you look at Mill Street paying 130 million of cash. So kudos to cannabis for getting that type of coin for the second facility. But we're very methodical and we're very reasonable with the way that we approach M&A, and we're also willing to walk away if deals start to get wildly overvalued. And so we're always going to have those conversations. We're always going to go to look to go deeper, but we also really like our footprint. So it's not like we have to make any moves. And again, talking about Florida, PA, Texas, and Virginia, I mean, nobody else has that footprint alone. And so when you think about what adult use combined looks in those markets, I mean, that alone is a standalone business that we're going to be able to have in our own. So M&A we're always looking at, and we'll be methodical and patient, and nothing to announce right now, but we're always having those conversations.
We get Spanberger to get on the phone with Shapiro in Pennsylvania and show him how it's done with a pretty conservative state in Virginia relative to Pennsylvania, at least.
It's funny when you look at Shapiro and every tweet's about, we're seeing tax revenue leave the state. And we're like, no shit. Like, we see it happen every day. You're literally seeing tax revenue leave your state to go to Jersey and other areas. But the good news is that, for PA, we have 18 dispensaries and a big cultivation facility, and the market is oversaturated with dispensaries from a medical program perspective. And we all built thinking when Fetterman was in office that, my God, that this was going to flip over to adult use. And what ended up happening is the delay after delay after delay. But the good news is that when adult use happens, we're hearing that it could potentially flip on quick, and that market will have the capacity to absorb what that adult use demand will look like. But I'll save a very crude comment. I'll just say, if I were Shapiro, I'd be looking to get it across the finish line. So
yeah, his job becomes much easier. There's more time, right? Like it's just.
Look what Virginia said. They're anticipating $400 million of tax revenue over the first 5 years. That's game changing for a state. And you look at a state like Pennsylvania. Every state could use more tax revenue. Let's be honest here, right? And so, and I like the way that Virginia rolled it out as well. 6% excise tax. Local municipalities can add 3.5 if they want, but they're not overtaxing the market like a state like Illinois did. So hopefully PA is paying attention and being very reasonable in the way that they would want to approach an adult use turn on. But yeah, time is of the essence. So
yeah.
Well, Aaron, we appreciate the time. What do we miss? What's next for Verano? Anything you want to get across to us, our viewers, et cetera?
Yeah, listen, we touched on a lot of the bullets, right? I keep hammering the footprint and the viability of the business. I'm not naive to rumors that are out there in the market, but we don't respond to rumors. We respond with performance, and so you can see the numbers that we put up. And again, I think there's things that we're doing that aren't necessarily hitting the headlines. Again, the move from Canada into Nevada, and being on a senior exchange. You think about who has the clearest path into the U.S. capital markets. I worked at the New York Stock Exchange, so I'm very familiar with what these markets look like. And again, you look at a company like Shopify. They're a Canadian-based company that trades in the U.S. and they're having trouble getting onto the Russell 2000. So what we're trying to do is eliminate any hurdles that we need to get over. So the way that we're building our business, and I hope people can appreciate this, is from a capital markets perspective. We're going to be ready to rock. We're not making any assumptions at the federal level, but if we get a thumbs up, we want to be a first mover in that space. From a balance sheet perspective, you saw what we just did. We have a $100 million line of credit through, Chicago Atlantic. We have, the term that is led by Needham, but Chicago Atlantic as well as in that. But we have flexibility behind that, and we have some massive catalysts that are in front of us. So managing our balance sheet and building cash is definitely, in the focus for where we're at. And the luxury of what we're doing right now is we're not struggling to keep the lights on. So now what we can do is take a step back and say, okay, how can we enhance the Verano experience, which we're doing? So again, bodega style in Arizona, and we're obviously going to roll out some exciting stuff across the rest of the dispensary footprints and making sure our CPG operations are up and running, getting more automated, more efficient, and that should all have an impact on the bottom line. And so, but we're not afraid to make moves, and I really like the way that we're positioned, and I don't think we get enough credit because obviously we had that massive lawsuit that was an overhang, and the debt was overhang, and now that both are aside, I would just encourage people just to pay attention to what we do. But yeah, that's it.
Well, we did and we do, and we'll see you, 3 months, 4 months hence. Hopefully.
Yeah.
Hopefully, well, we were just talking before we came on about lack of snow in Colorado, but lots of snow in New York and Toronto. So we will we'll be well past that, hopefully, by the time we talk next. So I appreciate Aaron, and Jeremy, thanks as well. And we'll connect with everybody later this week. Thanks so much, Aaron.
Jay and Jeremy, always appreciate our time, and I'll look forward to being back on in a couple months here.
Awesome. Appreciate it. Thanks so much.
All right, thanks, guys.
Thanks, Aaron.